Do you guys ever just, you know what? Never mind. Just go ahead and roll the intro. Hey everyone, and thanks for joining me today. My name is Matt, and I'm really excited about today's, or I guess the second episode of Watchlist Wednesday. But before we jump into that, I kind of want to talk about last week's analysis and how we're doing there. So last week we reviewed Peloton, we made our purchase, and I just reviewed it and don't have good news. We're down about $30 or so on that position. So down some money, but I kind of want to reiterate the fact that this is not this is not a short-term play. We are simply focusing on the long term for these investments. And as always, I think Warren Buffett said it best when the ideal holding period for something is forever. So we're going to hold on to these positions for a while. We're not going to start selling out of them because they've taken a little dip in the market. We're just going to continue what we've been doing and continue to invest. Because if we were to sell out right now, we'd be at a loss. If it rebounds, then we'd, maybe miss out on recovering some of the money or potential gains. So we're really going to ride this out. And that's kind of the point I'm trying to drive home with these, is these investments are not something that's going to be swing trading or day trading or anything like that. We're really here to play this for the long term. So today, the stock that we'll be reviewing is actually going to be an ETF. And the one that we're going to be taking a look at today is Vanguard's Real Estate ETF. The ticker symbol for that is VNQ. Now, the reason why I'm going with an ETF here is because I wanted to get some real estate exposure. I do like dividends, I like income producing investments, and I really think real estate's a good way to go about that. You can argue that real estate is a hedge against inflation. So right now in times where we're not really sure where inflation's going to go, real estate's a good position to have in your portfolio, as well as, again, it's going to produce a solid source of consistent income. So without any further ado, let's go ahead and jump right into that. So there's a few reasons why I'm choosing Vanguard's real estate fund as opposed to other ones. And we'll get into the details later, but just kind of a brief overview from my thought process so you know where I'm coming from for this video is, yes, it's not the cheapest, surprisingly, real estate ETF out there, but it is one of the highest yielding ones with a good cause or with the right, I guess, backing to it. And also, it's one of the more broadly diversified real estate ETFs. Sometimes real estate ETFs can have very minimal holdings in them. Sometimes they'll be invested in simply mortgage REITs or equity REITs. But Vanguard's done a good job with really diversifying that risk. And so it's got both mortgage and equity REITs in there. It's got, stocks of real estate companies invested in it, both ranging from small to large cap. So as I always mention, as somebody who likes diversification but without having millions of different holdings, it's really a good way for me to put my money into one place and be exposed to multiple different aspects of the real estate industry for making money. So now let's go ahead and just take a deep look at exactly why we're choosing this fund and comparing it to some others to see how it stands out. Last thing too, though, I should mention before we jump into why we're picking this one over other equivalents is when you're investing in something like a REIT or an income producing investment, please keep in mind that we're not investing in this for capital gains. So we're not looking for this fund to grow from, I think it's like $73 or something like that, give or take per share. We're not hoping that it gets to $200 by, August. We're really going to invest in this, specifically focusing on the income. Now, with that income, you always have really two options with it. You can either keep that money to yourself or you can reinvest it. So for sake of this series, if I have the ability with paper trading, we'll always go ahead and just reinvest the dividends to help grow our portion. Because ultimately what that does is, yeah, it's going to be slow and steady. But let's just say you're making $3 a year from these funds from owning one share of it. As you reinvest that over time, you're going to start owning more and more shares of this, which means a higher dividend. And then that kind of increase or, the compound interest, compound growth is really just going to grow exponentially from there. So this one, again, is not going to be something we're looking for growth like we are with Peloton. We're really looking for those income producing investments with this purchase today. And for today, I'm going to take you over to my computer and spend a lot of time showing you my screen. So my focus isn't going to be filming and recording my screen and recording the audio all separately. It's really going to be on more the audio and my screen. I'll leave the camera rolling just in case, but if you don't see me, it'll be okay. We're just going to talk through this one, and I'm hoping that this will actually be a relatively short video for today. So just a little bit more background here about this fund that we're going to be reviewing today is that this is actually still an index fund. So again, if you saw my video about ETFs and mutual funds, index funds basically means that it's tracking the market and ultimately trying to keep up with the performance of the market itself. Now this fund specifically here is tied to the, if I can find the page I was on. So this fund is tied to the MSCI US REIT Index. Essentially what that is it's like a real estate version of like the S&P 500 or the Dow Jones. So just another index that Vanguard is using to track the performance of this investment with and kind of see how it performs relative to it. And just one that's more specifically focused on real estate. So ultimately it's a more appropriate index to be using just because it's focused on real estate. Yes, there are stocks on the inside of this, but the goal of it is not to perform like the S&P 500. Again, this is something that's going to be more of an income producing investment than a growth investment. So it makes sense to have a different index using to track this just because of the relative performance. So over here, as you can see, this investment seeks to provide a high level of income and moderate long-term capital appreciation. So I've kind of beat on that a lot right there, that we're not investing in this for much appreciation. We hope to get some, but that's not going to be our main goal. We're really looking here for income. Sorry, I drew a blank right there. But let's go ahead and zoom out of this here. So I'm getting all of this information today from Seeking Alpha. If you're not familiar, it's just another kind of stock website for you to get some information. But the reason why today I am choosing Seeking Alpha as opposed to Yahoo Finance like I typically use is just because they do a really good job, or they make it easy to compare different products to its competitors. So if we switch over here, you see that we'll have, so this is the one we're looking at, ticker symbol VNQ for the Vanguard Real Estate ETF. And as you can see, it compares it to the iShares US Real Estate ETF, the Schwab US REIT ETF, and we're not really going to pay attention to this iShare Cohen and Steers REIT. Just because I've done my research on this and then I came across this table, and most of mine research that I did for comparing these was between Vanguard, this iShares one specifically, and this Schwab fund. So let's take a look here. So first thing, again, when we're investing in ETFs or mutual funds, the very first thing I always look at is the expense ratio. Might be a little aggressive of a thing to look at, but before I get myself excited on returns and investments that are inside of this, I always like to make sure that the expense ratio makes sense to me. If it's too expensive, I'm just going to pump the brakes right there and look at other options, because it's not worth paying 7% on a mutual fund just so you can get 4% higher of returns. As we've discussed, that's just going to eat away at your return. So that's why I always start with the expense ratio first. And the assets under management, so this is pretty big right here. You can see that the Vanguard fund is by far the largest one of these. I mean, it just puts these other ones to shame with how big it is. The sum of these three doesn't even add up to like a quarter of this one here. And really all that assets under management means is how much money the fund is holding. So this one has $28.06 billion invested in it, where these others are just shy of $5 billion. When it comes to week high, 52-week highs and 52-week lows for funds like these, I don't really care about them. Again, just hitting on it one more time, we're looking for income here. So the highs and lows, yeah, I guess it's something that you might want to take a look at or just at least be knowledgeable about. But when we're not as concerned with appreciation, then it's not something that's going to be a deal breaker for me. Because if I was just looking at the highs, I mean, yeah, the Schwab one, the iShares one has a higher 52-week high, but only by like a dollar. So it's not something that's really going to tell us that much information. Now, what I did see though here is the momentum. So as you could see, these don't look like they've been performing that well. And obviously the real estate market's taken a hit. So that's going to hinder the performance of it because we had that large dip. I'll see if I can show you a graph just this one time. You know me and graphs, I'm not a big fan, but just so you can see what it looks like. So that's why the performance is hurting, is just because of that dip that we had right there. But all of these funds are suffering that. So it's not something that's really going to separate one from the other, especially if they're all tracking similar indexes. But you can see that for the 1 month performance, which is a pretty short time frame, the Vanguard fund was the highest performer. And I guess coming back up here, that's something I always like to see because the return here is give or take 3%, just shy of 3% higher for the Vanguard fund over the Schwab one, even though the Schwab one's expense ratio is 0.07 compared to the Vanguard one, which is 0.12. That 3% makes up, for me at least, the difference in these expense ratios. Now, it's not a perfect calculation. You can't just base it right off that right there. But for me, that's enough to see because that, point whatever. You know what I'm saying. So, for me, I'm happy with that return. Now, each one of these funds pay a dividend. And one of the strategies I was actually considering with these is actually creating a ladder. If you don't know what a ladder is, basically all of that means is it's when if you have a fund that pays 4 times a year, so it'll be like March, June, August, and December when it pays its dividend. Some people might get something that would then pay like February, May, July, November, and then just kind of build a ladder like that. So that way each month they're collecting a dividend from a different fund, yes, but it's still a monthly income that they're going to be receiving. Unfortunately, with these funds, though, they all pay out at the same time. So it's not something that we would be able to build a ladder with. But that is a really good strategy, and it is something that I like. So kind of taking a look back into this. Again, as I was mentioning earlier, the Vanguard fund is a lot more diversified than these competitors. I know we're not going to include this ICF share, but 34 holdings compared to 186. I like diversification. That 186 is going to stand out to me, again, because I'm going to trust the manager here in knowing that they know what they're invested in and they're not going to have a lot of overlap in these investments. So not all of the time when you see those higher number of holdings, can you say that it's going to be diversified because there's always going to be overlap. But that's a good indication to me, especially knowing my experience with Vanguard. I know that the fund managers take that into consideration with, it's one of the top things that they're concerned about is making sure people are actually diversified and not just given a large number of different investments and think they're diversified. What you can also see here, and one thing I really like, is this turnover ratio. So the turnover ratio for the Vanguard fund is 6%. Not something I planned on talking about today, but just real quickly. Turnover ratio essentially is just stating that how many times the funds are bought and sold out of. So if a manager changes from one position to another, that would affect the turnover ratio. And if this were to be a mutual fund, then you are definitely going to want to take a look at that lower turnover ratio because that would have a taxable consequence on it for you. With this being an ETF, we don't have to really worry about that. But in a nutshell, that's basically what the turnover ratio is. And it's just something I like to see, a lower turnover ratio, because that also means that the funds aren't just being bought and sold and frequently being turned over in that account. It's truly an index, and it's just following something with occasional adjustments made to that position. And so what these betas are, and you can see these are pretty consistent. If you're not familiar with beta, again, it's a little technical of a term, but it's basically the market. So if you have a beta of 1, you perform relative to the market. If your beta is less than 1, then that means you're less volatile than the market. And if your beta exceeds 1, then that means you're more volatile than the market is. So as you can see, each of these are just slightly less volatile than the market itself, which for me, again, as the investor, is perfect. That's all I really care about, and that's all I want to see. So I'm A-okay with that. And now let's see what they're paying here. So with a dividend yield of 4.41%, an annual payout of $3.18 TTM. So that's just within the past 12 months, they've paid $3 per share with a 44% payout ratio. If you saw my video about dividends and payouts and all that good stuff, then you know that these are numbers that I really like to see. So this is going to be something good for me as the investor, knowing that one share is going to pay me out $3 each year. Now, yeah, $3 is not a lot of money by any means, but it's a good start because we're not going to buy just one position of this. And if that's kind of the game you're after, then you're not looking in the right place, because you have to understand that in order for dividends to produce substantial amounts of income for you, you have to have a substantial amount invested in it. So it's not like our $70 is going to pay us $300 a year. That'd be unrealistic thinking. So that's just something kind of worth mentioning, I guess, is these are numbers that I really like to see. And if you're confused with what all of these means, I'll leave a link below for my dividend video so you can have a better understanding for kind of what I'm talking about and why I like these numbers. And just, I guess, I don't think we might have skipped right over it. All right, yeah, so I did skip over that. I apologize. So the Vanguard fund also has the highest yield. So again, we're not always looking just for the highest yield, because if this said 15% for a dividend yield, that would have me a little worrisome. But it's under 5%. It's higher than these others without being substantially higher. And, I guess the closest one to it would be the Schwab fund. But we could see the difference in what's actually paid out each year. So this one's $1.31. The Vanguard fund is $3.18. So this is actually where I ran into a little bit of, do I want to pick the Schwab fund or the Vanguard fund? And the reason why I chose the Vanguard fund over the Schwab one is because the Vanguard fund is a lot more diversified than the Schwab fund is. It also has a little bit better of a performance and a little bit better of a track record than the Schwab fund does. Now, what made Schwab stand out to me, though, was initially seeing the lower expense ratio, that 0.07% compared to 0.12%, as well as the actual cost per share. So this Schwab fund was trading at, last I saw, it was like $33. My computer's not loading it, advertisements. But let's just call it $33.48. So just to kind of do the numbers, and I'll use my calculator here. So this is $33.48. We know the Vanguard fund was around $73, so it's at least double. So let me just do times 2, $66. So 2 shares of this is cheaper than one Vanguard fund. But on the flip side of that, you're getting paid out, what was it, $1.80? I really should have organized this better, and that's my fault. But for you to buy 2 shares of the Schwab fund, we'll just put it like that. So if you buy 2 shares of the Schwab fund, it's still going to be less than the Vanguard fund itself, but the dividends that you're going to receive are not the same. So just because you're paying, less than half for the Vanguard fund doesn't mean that you're receiving less than half of the dividend. So you would actually need like 3 of the Schwab funds to make what the Vanguard one is doing. And ultimately, that's going to be more expensive than buying one Vanguard fund. So I don't know if that makes sense. I think I did a pretty poor job explaining that. Hopefully some of you were able to stay with me there. Yeah. So that's why I ultimately end up choosing this Vanguard fund as the next investment. I kind of jumped to it earlier, but this is something we're going to add to the portfolio, because it's just another way to be diversified, because this is what we're going to use as a hedge against inflation while also producing income. So with that being said, let's go ahead and I will swipe over to the ETrade account. All right, and so here we are in the ETrade account. So, kind of as I mentioned earlier, our purchase from last week is not the way I wanted it to show because we're losing some money in here. And actually, I lied earlier. That was the day, not the total. So, we've lost about $900 from the purchase from last week. Admittedly, looking back on it, I definitely purchased at a little high. But since it's a long-term play, we're not going to sweat about it. We're still just going to let it ride out and see what happens. So let's go ahead and add this to our account. I didn't even think if this could handle ETS, and it can, so that's cool. All right, and let's go ahead and add an order for this one. So it is trading at 70, we'll just call it $73. We'll do 5,000 divided by 73. Be 68 and a half shares. I don't think we can do half shares on here, but that's okay. We will just call it, we'll just go with 69 shares. And we're going to buy these at market. So a little over $5,000 we're putting into this. That's okay. I'm also curious to see, though, how dividends are going to work out with this, because I don't know if we have like a reinvesting option in here, or if it'll just give me the cash. More on that later, but let's just go ahead and submit this order. All right, and sent. Cool. So that's really all we're going to do for today, is just we added that to our account. You saw why I chose that fund and why it's something that I feel is worth investing in. A little bit different here, but I just felt like right now would be an important time for us to try to preserve some capital while also having the ability to maybe produce some income with this. So that was my thought process. You also got to see why I chose this over the other funds. And really, I just hope you found this helpful. As always, if you did find this helpful, I hope that you'll go ahead and like this video. If subscribing is something that you're into, then feel free to do so. But you could be anywhere in the world and you're right here with me, and I really appreciate that. So thank you so much for your time today. Again, I hope you found this video very helpful, or at least maybe learned something. Really appreciative of the feedback. I'm sorry I'm going to butcher this name, but Kek LOL, KEKLOL, that's been commenting on my videos. Try to add a little bit more screen stuff to it to make it more attractive. So let me know your thoughts on there. Let me know what stocks you're considering. And until next time, hope you have a great rest of your day.